This is Tracy Burke, and for those of you who don't know me, my name is Tracy Burke, and welcome to the first of 5 sessions on personal finance series at Dairy Church called Having Your Financial House in Order. Thank you so very much for joining us this evening. It's a great evening to be inside with the weather here in central Pennsylvania. And I'd also like to give a special shout out and thanks to the Stewardship and Finance Committee for holding this series of events. So a few housekeeping items. If you have not used Zoom webinar before, a couple things. First of all, you should hopefully be able to see and hear me. Of course, if you can't hear me, you're probably having some other problems, but you should be able to see and hear me, but we cannot see you. So nobody on our end can see you. It's possible that either Sue George or Pastor Stephen could make a surprise appearance that you could see them if things go a little bit haywire on the back end. But again, rest assured, we cannot see any of you out there. So hopefully you're comfortable, have dessert and a drink or whatever you're doing at this point in time. There is a chat feature in your Zoom. So at the very bottom, and I'm going to be looking sort of around, I have a couple screens here. In the very bottom center of your screen, there should be, if you hover at the bottom, a chat button, and you simply click that. If you want to type anything, you can certainly do that. Only the panelists will see that. So that's Sue and myself and Pastor Stephen. Nobody else attending will be able to see what you type in there. So just for that information as well. We are going to have trying to keep it interactive. We have some poll questions that we're going to pull up throughout the course of the evening that a box will pull up on your screen. And just with your mouse, you'll click whatever answer you think the correct answer is. And then if all goes well, we'll see the collective results. We won't see anybody's individual answers or names or anything of that nature. We want to give a big thank you to Sue George for being the engineer, producer, and the tech master, among other things here this evening, as Sue does so well at Dairy. Everything she does is super well. So thanks so much to Sue for running the sort of the behind the scenes information here this evening. So shortly, I'm going to pull up some slides onto the screen, some visuals. You should still be able to see me in a small box on your screen somewhere, but the main part of the screen should be the visual slide that's out there. So anyways, that's a little bit of the housekeeping. So I guess, where I wanted to start with, what's really the goal of us doing these sessions? And I think, there's one big goal, and that's to help you, help people control your financial situation and not the other way around. A lot of times finances control us. Obviously, we want to be in control of the finances. So, we hope that you walk away with every session with, either or both reinforced information of things you've already known, and also learn some new things each time. There's going to be a lot of information that's going to be shared over these next 5 weeks. And but we want you to make sure that's meaningful as well. So we're not going to be able to cover everything into much detail. And a lot of this is meant to be a pretty broad overview. Please do know that at any point, I'm happy to answer any questions that you may have, whether it's between sessions, after the whole thing's over. If you want to talk offline at any point, I'm certainly happy to see how I can help and answer any questions that you might have. So materials, those of you that of course registered, I did send out emails in recent days, and hopefully you got the PDF of materials. There are also hard copy of the workbook and materials that are at the church, down to lower entrance between the doors. That's probably not as critical tonight. Between the second and third session, there's some workbook components to that it may be helpful to have those printed materials there. So if for some reason you can't stop by the church, you can't get your hands on the printed materials, feel free to let me know, and I'll see what I can do. If I can somehow get those materials to you, I will certainly try. If anybody is vacationing Hawaii, I would love to personally hand deliver those materials to you. But again, we'll try to get those to you if we all can. The one thing I realized within the past couple of days is the materials that we have here. There's no page numbers in here. Now, if you look in the first, behind the first page, there are sort of there's some page numbers listed over here on the side, but unfortunately none of the pages are listed. So what we're going to start with tonight for the first half an hour is everybody take out your pencil and everybody number all 180 some pages, I think is what it is. So I'll wait here for the next half hour as everybody does that. Just kidding, of course. But apologies that the page numbers are not there. The good news is there's tabs. So for each of the sessions, you just go to whatever tab and you go from there. The PDF does have page numbers in those, so that can be helpful as well from that. So that's a little bit of the background right there that we have there. There's some information that we'll share via email. Hopefully you did receive an email from me in recent days. Unless if you just registered within, I think today, I don't think I did see that list yet in order to send out those materials, but I will get around to doing that in the next day or two there. So the other thing before we dig in that I want to again make clear, please do ask questions. There's no dumb questions that are out there, whether you ask it via the chat feature, again, on Zoom, and I'll do my best to get to those questions throughout the presentation, or between sessions throughout the week or afterwards or any point, please do ask questions because, we want to make sure that you're understanding everything and it all makes sense. So without further ado, we're going to go ahead and dig in here a little bit. So just bear with me as I navigate. I feel like I'm sort of in front of an airline or in an airplane right now, navigating a bunch of different screens here. So I believe if I do this, and I think right now you should be able to see my screen right there. And the first thing we're going to do is we're going to pull up a poll question to get started. So if I do this correctly, you should see a question on your screen, which says, how much are you looking forward to these finance sessions over the next month? So please be honest. The first answer is, it's the most fun I expect to have all year. I would expect that to be a big answer. It's better than a root canal. Is it 8:15 yet? So those are your three answers. So go ahead, and I see many of you are answering right now. So just go ahead, answer radio button, take your mouse, click on whatever that answer is, and momentarily we will see the results. So hit on the radio button, hit submit at the bottom, and it'll come through. It looks like the vast majority of you did that from that one. So we're going to pull up the poll results here, and let's see, share results. Here we go. So if you can see on your screen, it's pretty much a dead heat between it's the most fun I expect to have all year and it's better than a root canal. A few people answered, is it 8:15 yet? So we'll get there in a little over an hour. But just so obviously a goofy question to get started with, but wanted to just make sure the technology works, get everybody used to it, and we'll pull some of these up as time goes along there. So hopefully that has disappeared now from your screen at that point in time. So with all that being said, we're going to take a look at the agenda here, and really tonight we're going to break down into three different parts. And those three different parts, we're going to start by talking about investment fundamentals and really what does that mean. And the second part, then we're going to talk about investing in today's markets and really 5 things that I broke down that I think that's important for you to know. And then the last part of the conversation this evening are 10 common investing mistakes and really how to avoid them as we move along. So again, everybody should be able to see my slides right now, and hopefully I'm in a little box at the top right of your screen or somewhere on your screen. If you cannot see that, if that's not what you're seeing, feel free to put something in the chat feature, and we can try to see if we can help you out from that standpoint. So with all that being said, and I'm just still trying to organize my screen here a little bit, but we're gonna jump into that investing fundamentals component. So where we're gonna start are the 2 most common types of investments that most people invest in. Yes, there's more investment opportunities that are out there, but most people invest in one of two ways, and that's in stocks or bonds. And this is basically when a company wants to raise capital or raise money for their business. They're trying to raise money for their business so they can issue either stock or they can issue bonds. So with stocks, basically the investor over here on the left is investing money into that company, and in return they get a share of ownership, and that's the shares of stocks. Bonds, on the other hand, is similar fashion where the investor is basically loaning money to the company. You're sort of investing money, but it's really a loan to the company, where that company is, through the bond, is issuing interest payments to you as time goes along. So as a result, if you're a stockholder, you're equity owners in the company. And if you're a bondholder, you're basically a lender to that company. And both of these really expect some type of a return for their investment. And as we go through the evening, when you're making any investment, you would expect some type of an adequate return for that amount of risk. Now, in theory, this is how, when a company issues shares of stock, this is all that works, or how that works. After that initial issue of stock, the vast majority of people will basically trade stocks on a secondary market. And we'll get in a little bit more depth as time goes along. But that's typically what we're experiencing, that most people, if you're selling a stock or even a mutual fund or whatever you're investing in, you're selling that on what we refer to as the secondary market from that standpoint. So if we move along and focus a little bit more on stocks, there's another word that's here up on your screen that means the same exact thing as stocks, and that is equities. So with equities, basically, as we said earlier, you're an owner. Now, how the total return on investment works is that there's two parts of it. So when you're investing in equities or against stocks, interchangeable words, the price of the stock that you own will change. It can go up or it can go down. Obviously, we like to see it go up. Then it also will pay a dividend. And that's basically some type of a return of the earnings of the company that you're investing in. So if you invest in Walmart stock, part of the dividend at Walmart stock will pay is through the earnings that they have. So that becomes a total return. So if I use an example, some years maybe the price will go up by 6%, and maybe the dividend pays about 2%. And this is percentage of your total investment. So if the price change is 6 and the dividend is 2, 6 plus 2 using modern math equals 8. And that becomes the total return on investment. So we'll revisit that concept a little bit later, but that's how you earn a return on the equity investments. Equities or stocks are higher risk investments. And as such, we expect a higher expected return when we're investing in those. If you think back to about 10, 11 months ago in the midst of COVID, when the stock market was declining in total about 35 to 40-ish%, there was a lot of risk involved with there. So that's something to be aware of. Now, if we move along, staying with stocks though, but we move along and talk about types of stocks. So stocks can be broken down between either domestic or international. And we think in this modern day age, many publicly traded companies are actually global stocks. But every company is either based domestically, their headquarters domestic or international. And then the next way we categorize stocks is by size, just like a drink size, large, medium, and small. Every company comes through that. Just to give you a sense, large size companies in the stock market, their stock price or the valuation of their overall stock worth about $10 billion. Mid caps are typically between about 5 and 10 billion. And then a small size company in the stock market is less than $5 billion in that range. So even the small ones, these are publicly traded companies, are very, very large when you're investing in those. The other way we categorize stocks is through what we refer to as style. So style can be either value, blend, or growth. So we're going to pull up another poll question here. And this poll question is going to talk about value and blend and growth. So on your screen, you should see a new poll question, which says, which of the following equity styles would you expect to have the greatest performance over the long term? So I know we didn't talk about that yet, we will, but sort of just polling to see what your initial reaction is. So do you believe value style stocks will do better than the other two? Do you believe blend will? Or do you believe maybe growth style stocks will do better? So go ahead and answer. I see some of you are doing so as we speak. Again, hit the radio button, then hit the submit button at the bottom of the screen there with what your answer is. And looks like most of you have done so, and it's really a dead heat here. So I'm going to pull up the results. Exactly 37%, thought it was value. 37% thought it was growth, and then the other 26% were thinking it was blend. So sort of a mixed bag of results there. The correct answer is actually value stocks. So with value stocks, these are companies that have what we refer to that they are a value in the stock market. And what that means is that the price of the stock is low in relation to what the real value of the stock is. So if I use an example, let's say ABC company, let's say in the stock market, it's worth $1 billion. So that's what the stock market worth is. But on paper, what the company's really worth is what's called their book value. So their, what their books basically show. That's why we call it book value. If say the book value of the company, what it's really worth on paper is 2 million. So again, in the stock market, it's worth 1 billion. On paper, it's worth 2 billion. That is a value stock. It's undervalued in the stock market. The stock market valuation is lower than what the true real worth of that company is. Growth stocks, on the other hand, are the exact opposite. So in that same example, let's say that the stock is still worth $1 billion in the stock market, but in that case, the book value would be worth maybe 500 million. It's going to be worth something less. So the stock market value is more than what the real value is. Tesla, guess what? Tesla is a big growth company from that standpoint, meaning it's overvalued in the stock market. So a couple important things just to know there. And again, value stocks do tend to outperform growth stocks over time. And we're going to circle back and show you an example of that a little bit. And blend is what it sounds like. It's a stock that's not pure value or pure growth. So the value of the company is pretty close to what the actual worth of it is from that one. So that's where we're staying there. So if we move on, we're going to talk about fixed income here. And if we move on in the fixed income world, and fixed income and bonds are interchangeable, the same type of thing. If I say bonds or if I say fixed income, means exactly the same thing. So as we said earlier, you're basically loaning money to the company if you're taking a direct issue bond. So you're an owner. The way you get a total return in the bond market is similar to the stocks. There can be price change of the bonds. The bonds can go up or down depending on the price movement. And then the bulk of the return is actually through interest payments. And so if you think about an individual bond, if you bought at the beginning of an individual bond issue, that's going to mature. Maybe you bought a 10-year bond. In 10 years, that's going to mature and you paid $1,000 for that bond. In 10 years, that's going to mature at $1,000. The price is going to change between now and 10 years. It's going to fluctuate depending on what the market is. But at the end of the 10 years, you're going to get back your principal, but throughout the ride, you're going to get your interest. Fairly similar to a bank CD, if you think about that, where it pays interest on a regular basis. Yes, it can be added to your balance as well. Bonds inherently are lower risk and also lower expected return. So stocks higher risk, bonds lower risk. Moving on, similar to stocks, you can, the issuers, whether it's government or corporation, which is the middle bullet point, they can be based either domestically or international. So a lot of governments have been issuing, all governments, frankly, issue bonds. Of course, the U.S. government, anytime we issue debt, a lot, all this debt that we continue to go into, they're issuing treasury bills or treasury bonds throughout there. That's the government portion. The corporate bonds that are happening there, again, that's simply corporations that are raising capital for further investment. And then the maturity or length of bonds, the shortest maturity of a bond typically is about 30 days. T-bills, treasury bills, that's the length, starting with the length of 30 days there. And bonds can go to 30 years or more. Some companies float bonds that are 40, 50, 60 years that are out there. So again, if you have any questions, use the chat feature. If you're struggling with technology, use the chat feature. Sue is keeping an eye on that, and she can help you out as well there. So as we move along, we're going to talk about individual securities versus mutual funds. So an individual security, this could be a stock or a bond that we just talked about. So that can be a company or a government. Obviously, these are companies that are listed up here. Google, McDonald's, and I'm not sure how many people have heard of this one on the right-hand side. I think it's called the Hershey Company. But those all three of those have issued stock in the past. They could issue new stock if they want. They issue debt instruments, meaning the bonds as well. You can invest directly in any stock that's out there. And in the worldwide stock market, I think there's about 15,000 different publicly traded companies worldwide. In the US, it's a little over 3,000, but you can invest directly in those individual stocks. Many people invest in mutual funds. And many of you probably own mutual funds. In 401ks, a lot of retirement accounts, predominantly those are mutual funds that are out there. And what a mutual fund is simply just a collection of individual securities. So these names listed here, Vanguard, which is actually where I started my professional finance career, worked there for a while, Fidelity, Two Year Price, these are some of the bigger names in the industry that provide mutual funds. And what they are, a mutual fund is, again, a collection of individual securities. Sometimes there might be 50 individual stocks or it can be bonds in a mutual fund, up to thousands of individual holdings within mutual funds. The good thing about mutual funds, they're more diversified than owning an individual stock. Now, if you take everything, whether it's in your 401k or an investment account, and put it in Tesla, you're not super diversified as you can imagine. But if you put it into a mutual fund that has maybe 500 different stocks within it, that's where you're much more diversified. So with that being said, mutual funds are by far the best way for most people to invest your serious money. Now, it's nothing wrong with picking a couple stocks with some sort of play money, smaller amounts for your situation, and putting it in those stocks to see what happens. But you certainly don't want to take your nest egg and let's say, hey, I heard a lot of good things about Bitcoin, or I heard lots of good things about Tesla. Let's see how this flies and let's put everything on it. That's a bad idea. So of course you wouldn't want to do that. The next thing we want to talk a little bit about is what we refer to alternative investments. So far we've talked about stocks and bonds predominantly, and we're going to move on and talk about alternative investments. So these are not equities, meaning not stocks, they're not fixed income, meaning bonds, and they're not cash. So these are often looked at whether it's what we call private equity deals, venture capital, hedge funds, real property, which can include whether it's real estate, art, antiques, commodities as part of that, gold, silver, and I have listed down there to weather futures. So, commodities, you can invest in commodities directly in gold or silver, but you can also invest in sort of predictions of certain things. And one of the weirdest ones that I always think out there are weather futures. So you can put money on what are the weather futures that are out there. Looking at some of the local TV weather people, I'm not sure, it doesn't seem like it's probably a good thing to invest in weather futures from that, since they're not always spot on. So alternative investments, these are things that most people do not invest in. If you're extremely wealthy, you can do it, but here's some of the reasons you would or you want it. The pros on the left-hand side, it says it's non-correlated. So that means it does not move in conjunction with the market. So if the stock market goes up, often alternative investments don't go up or down the same level. And that can be good because, if everything's moving the same direction, if the whole stock market goes down 30% and the other, alternative investments go down 30%, that could be some trouble there. So they are non-correlated, which is a good thing. There's some additional diversification, meaning that they're not stocks or bonds. And if you strike it well, you can get a pretty high reward potential because some alternative investments return 20%. They might lose 90%. So there's high risk, there's high reward, but you can also lose absolutely everything that you have there. The cons of it, it's very difficult to value. With a stock or with a mutual fund, every single day you can look to see what is that investment worth. With alternative investments, most of the time it's not what they call marked to market, meaning that it's not valued on a daily or regular basis. They're often very illiquid. So you put money into alternative investments and often you can't get the money back when you want. You have to wait to an open window or an open period where they allow you to take out that money. Often they're very unregulated, and that's maybe not such a good thing sometimes in the financial industry. High risk, as we talked about, and the other part is the high cost. Sometimes those are 2 to 3% annual fees, and there's some tough things in there. So I wanted to talk about it, but right now the point is most people should not be investing in alternative investments. Typically doesn't work. So we're going to move along and talk about some risks with investment. And I'm going to start to pick up the pace here a little bit. Market risk. That's basically that whatever you're investing in, stock or bond, that may lose value. So as an investor, you should know that when you're investing, hey, the goal is for this to go up, but it could also go down, and you have to be willing to accept that. Inflation risk, you're all aware of what inflation is, that something in 5 or 10 years from now will likely cost more than it does today. And it's important for your portfolio, your investment portfolio, to outpace inflation. So the cost of things later on won't be as monumental and coming through there. So that's more of a longer term concern. If people invest everything they have into bank CDs or bank savings, those historically are not, especially in today's low interest rate environment, are not going to stay up with inflation. Liquidity risk, again, I said that before on the last page, where liquidity risk is basically that whatever you're investing in, you may not be able to sell it and get out of it when you need it. So it might not be accessible, or maybe there's penalties with it. There's a couple of investment risks that are only focused on fixed income or the bond side of the equation. So credit risk, what that means is that issuer could certainly default. Most of the time, if you think about governments, could the government default and not pay their debt back? Not really, because what they would do is just tax us further. So they would tax us further from that standpoint. So typically governments do not have credit risk on bonds, but corporations certainly do from that. If you think about, let's say Kmart, would you want to buy a bond from Kmart right now? Probably not. I think Kmart still has a handful of stores or a couple dozen stores nationwide, but probably not something you want to invest in Kmart right now. Interest rate risk is that when interest rates go up, the value of the bonds fall. So that's a risk when you're investing in bonds. And then the last one is maturity. So from the maturity side of the equation, longer term bonds are more risky than the shorter term. And that's what this is sort of showing. The bottom axis shows time. The longer term the bonds, they're more risky. While you are getting more yield, there's more risk to those that the price will fluctuate. So we have a question, and like I said, I love questions. So the question is, do you consider Bitcoin an alternative investment? Absolutely. Bitcoin is not a stock. It's not a bond. It's in a sense a type of a currency. Very, very risky in some sense. It's very speculative as well. I'll mention a few other things about that when we talk about gold and silver and some of the other more speculative investments recently. But good question. One of the big things that we've been hearing a lot of, a lot of people are interested in Bitcoin. Very, very dangerous to invest or invest a lot of money in. Let's put it that way. So let's move along. We're going to talk about this next section, which is how to invest in today's market. So I broke it down into really 5 things that I think that you need to know. So sort of an opening disclaimer is that a lot of this remaining content, well, what we just talked about is sort of, classroom-like, that's textbook material. A lot of this is mostly based on the past. And of course, we're not trying to predict the future. So don't, tomorrow say, hey, I heard Tracy say something last night, I'm going to buy, a bunch of this. Please don't do that. It's probably not the right, may not be the right thing to do. So before we move on, I do have another poll question here that I am going to pull up. So let me set that up here. And that question should be appearing on your screen right now. The question is, what best determines performance? Is it timing the market, trying to time the market? Is it B, picking the right stock or mutual fund? Is it both of those two, both A and B, or is it neither A or B? So what is the best determinant of performance? Again, trying to time the market and figure out, hey, the market's down or up or whatever it might be. B is picking that right stock or mutual fund. Well, is it Tesla or is it this or that? Is it both of those two, or is it neither of those two? So go ahead and answer that, and we'll pull up the results in a moment. All right. See, most of you have answered here, and let's share the results here. And the winner according to the poll was C, which is both A and B, meaning that what determines performance is trying to time the market and picking that right stock. The correct answer, or at least the supported correct answer, is D, neither A or B. So what we're going to take a look at first here on this chart is a donut chart that's sitting there, and the question that's asked there: what determines performance? This is a study way back in 1986. I've heard people over the years say, "Oh, well, that's 35 years old. That's way too old from that one," which I think is not too far off when Pastor Stephen was born. Hint, hint. But being a study in the financial services industry, yes, that's fairly old. But there's been a lot of studies since that point that reflect the same type of thing. That the biggest determinant of performance is actually how you're allocating those assets. I'm going to talk what that means. It's not market timing, which was A or B. It's, again, it's how you allocate those assets. So if we move along, with asset allocation, and the top of the screen says strategic asset allocation. So what does asset allocation mean? It basically means that, what asset classes are you including? And most of the time it's stocks or bonds. There's cash that's involved, and there's some alternatives that we highlighted out there. But really what determines is how much you have in stocks versus bonds, and not trying to time the market and not trying to pick what's hot. Because often when you try to pick what's hot, it backfires and you're buying at the wrong time. That's something we're going to cover here a little bit more. So again, the most critical decision you're going to make is how much do you have in stocks, how much in bonds, and how much in cash for most people. So something to think about from that standpoint. The other question is the level of volatility, because again, some of that is more volatile than others. So what are you willing to accept in terms of volatility? Keep in mind that stocks and bonds don't go up every day, week, or quarter, or those nature. I'm going to pull down the slides here a couple of minutes because it makes me think of a story. I have a long-term client who's still a client who's actually a clergy member, and certainly not Pastor Stephen, but and this was he's a rabbi. He used to call me, and this was probably 10 or 12 years ago, not long after we started working together. He said, "Tracy, something must be wrong. I got my latest statement, and my balance actually went down. Something's going on." And I said, "Rabbi," I said, it's that happens. The market does not go up every day, every week, every month, every quarter, not even every year. And so explain that to him. He's like, "Oh yeah, no, I should have known that," so forth of that standpoint. And so a month goes by. The next month, another down month. He calls up, "Something must be wrong," and repeat it. He must have done that a handful of times. And I finally said, "Hey, Rabbi, we keep having this repeated conversation. I keep saying, that the market doesn't go up and up every single month or quarter or whatever it might be. So you have to have that the ability to stomach what's that volatility. I also see a great question, and any terms that I say, if you don't understand what they mean, please do ask. The question was answered was, what is volatility? Volatility is simply those ups and downs that your investment may experience. So your investment may go up 20%, it may then go down 10%. Or whatever it might be. If you think back in last winter and the spring, lots of volatility in the stock market. The stock market in 5 weeks went down between 35 and 40%. That's a lot of volatility. Normally, that's not what the stock market goes up and down so much. Of course, COVID-19 had a lot to do with that from that one. So that was the one question. Another question is, what are thoughts on target date funds through mutual funds where they set the asset allocation for you based on the predicted retirement date? Those are wonderful funds to invest in. Most retirement accounts, 401ks, whatever it might be, often have those target date retirement funds. So maybe it's a target date 2030. If you want to retire about 2030, that's a great fund to pick. That picks a stock and bond mix that is appropriate for somebody that's going to be retiring about age 2000 or in year 2030. So again, those are great funds to do. They're well diversified, which is one of the next things we're actually going to talk about. Proper diversification. They have exposure to all parts of the market, US, international, bonds, you name it. And the great thing about those target date funds, as you get closer, as time goes along, you get closer to that year. And again, if we use a 2030 year example, it becomes more conservative. Because as you get closer to the use of those funds, closer to retirement, you do want to become more conservative. So yes, target date funds are fantastic vehicles. So thanks for all the good questions that are coming in. I'm going to go back and jump into the screen again. And we're going to talk about diversification. I just mentioned with that question there, what that diversification would look like. And here, what we're seeing here, there's no basic way to predict what's going to happen next. Just like the weather people don't always get it right, trying to predict what's going to happen in the stock market, very futile. What you're seeing here in the left-hand side are large, mid, and small. You learned that a little while ago, what that means, the size. And then growth, value, and blend out here. Cap just means the capitalization, the size of that. So what this shows over time, the highest return every year is dark blue shaded. The lowest return is this. A lot of this is an anomaly that we're going to talk about later, but you see there's no real rhyme or reason. There's several cases that the worst performance, here's an example, small cap growth in 2012. The next year it led the way. Often what doesn't do well the previous year sometimes will lead the way in the future. So no way to predict what that's going to be. If we move along, oops, a little bit too far, bonds. So we talked a little bit about what, with bonds and all those type of things that are out there. So the question is, why do you need bonds? Because there's a lot of people say, the phrase, be an owner, not a loaner, something that rhymes. And keep in mind, owning stocks, you're an owner. If you're investing in bonds, you're a loaner from that standpoint. But bonds are very important. And really, it's that added stability. So we talked about volatility. The volatility means lots of ups and downs, but added stability is very important than bonds because bonds are much, much less volatile than stocks. As we talked about at the beginning, the rate of return that you would expect on a bond investment is much less than what you would expect on a stock investment. So if you think about, a 60-year-old that's going to retire in a few years, versus a 30 years with many years until retirement, the 60-year-old probably wants more in bonds because that's more stability in there. So what you're seeing on the chart right now, the S&P 500 index, which is an index that often we rely on a lot here in the US. That's one of the most common indices that you hear. That's simply the largest 500 stocks that are out there. The largest 500 companies that are in the U.S. are from, in that S&P 500 index. So you can see from 2000, these are actually, there was a fifth year, but these are the 4 years from 2000 to 2019 that the U.S. stock market, represented by the S&P 500 index, was negative. The fifth year was actually 2018. It was only negative by a couple percent, so I didn't put that on the slide here. But this is what the stock market, US stock market, really declined in those calendar years. 2008, probably you remember that. But look what the bonds did. And this is a bond index, aggregate, meaning all the bonds that are in the US. What did they do? Well, when stocks went down, these did really well. Typically over the longer term, stocks do often between 8 and 10%, and bonds typically do 4 to 5%. So 4 to 5%, if that's what the average for bonds, this is much higher than the average. So again, when stocks go down, bonds typically do really well. That is the cushion, and that's the important reason why you need that mix of bonds in your portfolio. Now you can see the average over the 20-year period for stocks was 6.1, and there's some pretty big down years here. And the average for bonds over that same 20-year cycle was 5%. You probably just heard me say that average for stock performance typically between 8 and 10% for that one, from that. So that's the importance of why you need bonds. So as I've been sort of harping on, it's important to determine how much you need in stocks on the left-hand side or bonds. And again, if can you stomach that downturn with the stocks? And so there's a couple things that are important to think about. What is your risk tolerance? And what is your time horizon? When do you need that money? If you need the money anytime soon, stocks, you don't want to lose a third or a quarter of that stock, your stock investments. That's why you want to have a balance of those two. Here's some parts of the stock market, not saying you do want to have exposure to all these little parts around it. On the bond side, there's some things that maybe you don't want to have exposure to. Long-term bonds right now with the low interest rate environment probably doesn't make sense. International bonds, some of you may have heard this. I think over half of international bonds that are out there are actually at a negative interest rate. That's a completely other conversation to talk through of why that is the case. But at the very bottom of the screen, again, the point is, this is going to be your most important decision. This is what determines performance. How much you have in stocks versus how much you have in bonds. So, there's another comment or a question that says, during the last year, I've read from various sources that the typical bond stock recommended ratio needs to be thrown out the window. Often what we hear is the amount of that you should have in bonds is basically if you take 110 and subtract your age. That's typically what you should have in bonds. From that perspective. No, I'm sorry. You should have that in stocks. I reverse that. So if you take 110, and I'll pretend I'm 30 years old. Yep. So I'm 30 years old. So 110 minus 30, math is 80%. That's what you should have in stocks. That's sort of those rules of thumb. So again, take 110, subtract your age. That's that general rule of thumb of perhaps what you should have. Don't utilize that because you want to think about what is your risk tolerance, when do you need the money, all those other important things. But as a generality, I still do believe that's true. Every time the market goes down, people say throw out all the general rules of thumb. But guess what? People said this market's never going to recover, or it's going to take years or even longer to recover. Guess what? We were back above water by August or September. The 2020 stock market was better than it was better than average. So I think a lot of that is very important through there. We're going to talk about the stock market and how it's really a leading indicator. This is another question that came in. The stock market is often a leading indicator of where the economy is going, and it often goes there first. So if we think last year, about a year ago, the stock market started to decline in mid-February. While some of the COVID things were already in the US, it was before it got really ugly. And the stock market hit rock bottom on March 23rd last year. If you think about March 23rd, that's when a lot of businesses were saying you're going to work from home, and schools and everything was shutting down, sports were shutting down. And the spring, the stock market grew tremendously. So the stock market's that leading indicator from there, which is important to keep in mind as well. So if we move along, something that I'm going to talk through here in terms of what you see on the screen is bring risk into the equation. We've talked about return some, but it's very important to bring risk back in the equation. So we want to balance that risk or return versus that expected return. So a couple things to point out here. Over the past 30 years, and this is using portfolios with indices, some of those same indices that we were using on some other ones, broad parts of the market. Down here, 20% equities, 80% fixed income. And it keeps getting more aggressive as you go to the right. And on the right, it is 80-20, 80 stocks, 20 bonds. What these bars show is the range of returns over that 30 years. So the best return over the past 30 years for an 80 stock, 20 bond portfolio was, let's call that 27%. That's where the top of that bar. The worst was probably 31, 32%. My guess is that was probably in 2008 was the worst for an 80 stock, 20 bond portfolio, but the range of returns. As you see on the right-hand side, that range is deeper than it is on the left-hand side. The left-hand side is the more conservative. Remember, less stocks, more bonds, that's more conservative. So the highs aren't as high, but the good thing about being more conservative, the lows aren't as low. So if I draw a line sort of connecting the top of each of these, there is an upward slope. It's not very dramatic though, right? It goes upwards, but not very dramatic. However, on the bottom side, the slope going down is much more of a sharper angle than it is going up. So when you get more aggressive, yes, you're opening yourself up for better upside, but you're really opening up the door for a lot of downside. The line across over those are all the average returns over those cycles. So these are the average rates of return. So you're taking a lot more risk over here. You get 8.11%, where the average return for a 20 stock portfolio is about 1.5% less. So you have to balance, is it worth getting a 1.5% more each year, but having all that volatility? Here's the past 10 years. That's looking a little bit different, in a shorter time period. Not much downside risk. Again, this goes through 2019. Even if it included 2020, it'd be the same thing. Besides the market downturn last spring and the subsequent recovery, that has not been that it was a pretty good 10-year run in the stock market. So another question I see here talking about that rule of thumb, the 110, it says, should my spouse and I both use 110 age? We're 10 years apart. That's a great question. And it depends on if you're relying on each other for your finances and supporting each, sort of looking as one pot of money collectively, then, that might be something you want to take that with a grain of salt, so to speak. Again, I would just be very careful and not just say, okay, well, I heard Tracy say 110 less my age, that's why I should have in stocks. There's so many factors, sort of the middle range, person, probably that's pretty close to being appropriate. But again, there's a lot of other factors that are important here. So what you're seeing on the screen right now, it is important to invest globally, not just in US stocks. There are plenty of people say, why should I have international in my portfolio? Well, if we take a look at this, and this is supposed to be a quasi map, I know it's square and boxes, but what this shows is that the U.S. stock market makes up a little over half of the worldwide stock market. The dollars invested in the worldwide stock market, a little over half are from U.S. companies or based in U.S. companies. There's emerging markets, there's developed markets, and so forth, but so if you put everything in US stocks or US stock market in mutual funds, and you don't include any international, there's a lot that you're missing out. So it is important to have a global portfolio there. This is sort of drills it home a little bit. That S&P 500 index that I mentioned, that's the US. Believe it or not, most S&P 500 index funds have not 500 stocks, but 505. Some of them have 508. For goofy reasons, but you're invested in 500 stocks, where the global market is, you have exposure to almost 9,000 stocks, 46 different countries. Not all those small countries have their own stock market, so there's generally about 46 countries that have stock markets worldwide. Something else here that's always, really interesting to me, and tell you what, I want to back up because there's a poll question on this, and I almost gave around off the answer here. So I'm going to pull up another poll question here, and let me pull this one up here. I think this is the one. Yep. All right. So you should see on your screen right now, since 1926, so this goes back almost 100 years, That S&P 500 index, which again represents US stock market, has averaged returns of really between 8 and 10% on an annualized basis. How many years since 1926 has the S&P 500 index actually had of a return between 8 and 10%? So again, the stock market historically returns on average between 8 and 10%. The question, a lot of years it returns greater than 8 to 10%. A lot of years it returns less than 8 or 10. The question is, how many years in the past, say 95, has the US stock market returned actually somewhere between 8 and 10%, which is what we say average is. All right, so see, a lot of you are still thinking through this one, and a lot of you are still answering. This is one you have to think a lot through. Results are somewhat predictable so far, so I'm going to go ahead and pull up the results here. And the results that you can see here is actually, so 44% of attendees have said that 13 years out of the past 90, 95 years, the stock market actually returned somewhere between 8 and 10%. The right answer, and some of you may have known this from previous conversations or the last time we did this, is actually 0. Believe it or not, there's not been one time in the past since 1926 that the S&P 500 has returned between 8 and 10%. That always just blows my mind every time I think about it. This chart sort of shows that. This is going back to 1926 S&P 500, and not one time, these dots are darn close. Those are just outside of it, just on the bottom or the top side. But not one time in the past 95 years has the U.S. stock market had a return, the S&P 500, somewhere between 8 and 10%. Pretty staggering. So when we're thinking of expectations of returns, we think about that, and like I shared that story of the rabbi expecting positive returns each and every month. A lot of times, as investors, we have unrealistic expectations. We're like, hey, I want 15%, rate of return. Another quick story: I have a client that's up in New York City, a longer-term client, who conversation within the past 2 or 3 months said, hey, Tracy, 2020, seems like we're actually now getting a pretty good rate of return, but I'm really hoping for 15% returns. And I just sort of chuckled, and I thought to myself, wow, I must have done a horrible job advising this person over the past 10 years of a relationship if she really believes that 15% is a realistic return. And I said to her, it's not, unfortunately, it's not realistic. If stocks historically go up between 8 and 10, percent on average, bonds go up between 4 and 5. Do the math. We're not going to get to 15%. But again, just shows that return expectations, sometimes it's tough to expect those, or expect more than what it will give it. So the next thing we're going to take a quick look at here is there's some premiums in the equity side, and these are long-term premiums, as the top shows. We talked about small versus large stocks. And the truth is that small stocks will typically outperform large stocks. And that typically makes some sense. Now, a couple things. This is cyclical. It doesn't happen every single year, so it varies a lot. And this is a historical trend, and who knows if this will continue. We would expect it to from that standpoint moving forward. So with that being said, small typically does better than large. These are rolling, or what's referred to as overlapping periods of time. So over almost the past 100 years, in 5-year cycles, these are 5-year cycles. So 2015 through 2019, 2014 through 18, and so forth. 60% of the time, small stocks outperform large when we're looking in 5-year cycles. The probability of success goes up as your time period gets longer. So if you invest over long periods of time, you can put more into small caps and expect those to beat large caps. Now, again, don't run out tomorrow, sell everything you had and put everything in small caps, because Tracy said last night that small caps do better than large. It's balance, and that's an important thing. The next thing we want to take a look at, and one of the first poll questions, if you remember, which does better, value versus growth? The answer was value stocks. This is where the proof is. Now, over 5-year cycles, again, these are those rolling cycles, 5-year times, it's a complete toss-up. 50% of the time value does better, 50% of the time growth does better. But the longer cycles, that value stocks historically outperform growth when we look in the longer periods of time. The good thing about value stocks, they're also less risky. So that's important as well. But I would, one thing I would share is, as I mentioned before, that balance is just so important. And I always relate it to like eating a well-balanced meal. So some of you that know me might know that I'm a French fry junkie. So my favorite meal may be, a main course of regular fries with a side of curly fries, and then let's have tater tots for dessert. But if you think about it, that's probably not going to be best for my long-term health. So the same type of thing for your long-term financial health, balanced diversification. You don't want to put everything in value stocks. You don't want to put everything into small stocks from that component. So as we move along here, the next thing we're going to take a look at is bonds and sort of a fixed income strategy. So this is, if you've been falling asleep, I'll tell you what, bonds, this is the exciting portion of the evening as we talk about bonds. What you see on the screen here is squiggly line, and this is the US, these are 10-year treasury bonds, the interest rate that 10-year treasuries have paid throughout history, starting back pre-1920, basically going up. I ran this chart in mid-December of 2020. And what you can see is that this period of time from 1920, as going into the 1980s, this whole chunk of time over here, bonds were returning somewhere around 3 to 4%. When it peaked in the late 70s or early 80s, interest rates were really sky high. And some of you may recall that period of time. I was just talking with one of my oldest clients I think she's 91. She's out in California. We had a video call earlier today, and we were actually talking about this very thing when interest rates were so high in the late 70s, early 80s. And she said, I remember I had a mortgage, I think that was 12 or 13% back at that time. Imagine that. Interest rates were really high. Now, as a bond investor, when interest rates are high, it's good to be a bond investor because you're getting that interest, right? So, if you bought a 30-year bond, these are 10 years, but say in 1980 or this period of time, if you bought a 30-year bond, I think the going rate of 30-year bonds was somewhere around 20% in that period of time. You would, for the next 30 years, you would have 20% rate of return. Amazingly, I've never had a conversation with anybody that actually bought a 30-year bond that's paying 20%. But what a great thing for anybody who must have done that. Interest rates since that period of time, and inflation was sky high too. So interest rates have plummeted. This was, again, as of mid-December, where interest rates were less than 1%, the 10-year treasury bond. I use that one because that's sort of a general one. So the point is, why are interest rates so important? Well, it not only dictates what interest you're going to receive, and again, think about those bank CDs, but the price side of the total return equation comes into play too. There's a relationship between what bond prices are versus interest. It's an inverse relationship. We're not going to dig into much deeper than that right now. But what that ultimately means is going to be on the next page here, that most investors should use high quality and short to intermediate length or duration type bonds. It just does not make sense to go into lower duration bond or longer duration bonds or low quality. And that's what this chart sort of shows. Here's the returns. The returns start to level off somewhere in this area. You see that they start and then they level off again here. Standard deviation is a measure of risk. This is a risk line. So while returns start to level off, risk does not. So you heard me say earlier that longer term bonds, there's more risk that we have through there. So I'm going to jump ahead. There's some information in the booklet on some of these concepts that are out there as well. And again, that workbook is there, and see some comments. Remember, higher mortgage rate, interest rates of 15%. Absolutely. Some of those type of things that are out there. So we're going to move along I'm going to jump through some of these slides just for the sake of time. We're going to talk about 10 common investment mistakes and really how to avoid them. So, much of what's in this section is really based on investor behavior. And, sometimes it's tough to behave well when investing. And when you're investing in the stock market, it's really easy to make behavioral mistakes, and that the result that you end up with can be very devastating. So here's a study by a company called Dalbar, a third party that does this study. It updates every few years. Over the past 20 years, or most recent 20-year cycle, the S&P 500 index has averaged a little over 6% on average per year. The average equity fund investor, the average equity mutual fund investor, has earned 4.25%. That's what I call the behavior gap. So the average investor earned 4.25% investing in stocks, where the actual stock market earned 6%. A lot of that is into the behavior. Some of that is buying at the wrong time. That's one of those behaviors where it's so easy to buy at the wrong time. Successful investors buy when the market is low and sell when it's high, or higher, lower and higher. Speculating, a lot of people end up speculating, and speculating is focusing on the short term. Mentioned Bitcoin. Bitcoin is a very speculative investment. If you get in at the right time and you got in low and it's higher and you get out, you're going to make some money. But it could easily go the opposite direction. It's not a good long-term investment. So a lot of this is going to be investor behavior. So let's breeze through some of this. Diversification, improper diversification. You can be overly diversified, where you're either an investor or a collector. And what happens, you're reading in the newspaper, hey, this is a hot stock or a hot investment. I'm going to add this to my portfolio. Then a couple of weeks later, you do the same thing. You keep adding what seems to be hot at that point in time. And all of a sudden, you look around and in your portfolio, you're a collector. You're not really investing. You have all these stocks. There's no cohesive strategy. So there is a way that you can end up with too many securities, or not a cohesive plan. The other option is under diversification. So you probably all heard that phrase, eggs in one basket. So really, what does that mean? The church's investments are all in Vanguard. There was a question, what is the church's rate of return on their Vanguard investments? It's very good. I can't quote it off the top of my head. I'll be more than happy to share that with everybody, and I will get that answer and share it next week on there. I'm just making myself a note because I don't want to misquote it, but it's quite stellar. The eggs in one basket, again, the church has all their accounts at Vanguard. That's fine. Having everything at Vanguard, that's not eggs in one basket. Having everything in small cap value stocks, because you heard me say small cap does better than large, and value does better than growth, that is eggs in one basket. So having your assets in one location, whether it's with a financial advisor or whether it's at a financial institution, there's nothing wrong with that. That's what we call consolidation. But you don't want everything in one sector or one asset class with that one. So it is possible to be certainly under diversified. So you want to make sure that you're well diversified throughout your portfolio, domestic, international, small, large, mid-sized stocks, bonds, the same gamut, all of those type of things. So what is proper diversification? If you do have proper diversification, you are reducing those risks. And that's a very important concept to really think about. If you're concentrating on one stock, you're putting a lot on there. We encourage people not to have more than 5 to 10% of your portfolio in any one stock. If you think about, this might go back some time, but Enron, early 2000s, Enron was one of the biggest and most stable companies in the world. And we know what happened to them. WorldCom was another one, Lehman Brothers, General Motors, they're still around, General Electric, they're still around, but they have fallen on some hard times. So never have more than 5 to 10% of your portfolio in any one stock. That's why you want to use mutual funds, what we talked about before, or the somewhat equivalent of mutual funds, which are ETFs. And again, broad basket of securities. And that's what the bottom of the screen shows. You want that diversification so you're not putting all those eggs in one basket. Most of our clients at my firm have 10,000 plus stocks, global stocks in their portfolio for that very reason, smooth it out. And as it shows here, smooths out a lot of those bumps as we move along. So the second item moving along to is reacting to, in this case, euphoria. So this usually happens when the market's doing really well. The fourth quarter 2020 was great. And it's easy to feel that, when the market's going up, that, well, it's not going to go down anytime soon, but the market bottom can, fall apart at any point in time. Another one of my clients, this is one that actually lives in Houston. Every single time the market has a great run, she calls up and she wants to add pretty big chunk of money in the portfolio. And every single time I say, well, we're sort of buying high. The market just had a really good run. And of course, when the market goes down, when you call up and say, hey, if you want to put something in, maybe this is a good time, take cash and put in. And of course, no, it's, the market's all over the place right now. So you want to buy low and sell high. So it's easy to be overconfident, ignore the risks that are out there, and even be greedy in that case. The other thing you can do is react to panic, which, whether it's current events that are out there. And, this phrase that it's okay to fear, but not okay to act on fear. I think that's very important to think. If you're working with an advisor, it's good to talk, that advisor can help you talk off the ledge and bring the emotions off the table. Because as an investor, and I feel the same way with my personal, assets, you think, wow, the market's falling apart. Should I pull out? That's one of the worst things you can do. So making sure that you're not reacting to what that panic is. A lot of people do the opposite of what you should. A lot of people buy high and sell low. And as we talked about, you should do the opposite. Sell low, buy high. I've heard a lot of people say, even a couple months ago, oh, I got to get out, until we see who wins the election. So I got to sell out the stocks until we see that. Bad idea, typically. Because if you miss some of the best days in the market, this is in your booklet, so I'm going to breeze by this pretty quickly. But if you miss some of the best days in the market, that can really hurt your performance. So speculating and investing, we talked about Bitcoin. This is, sort of a common example. Partly, whatever Bitcoin really falls into speculation, at least in my opinion. So, that's when you're betting on individual investment or sectors or the market as a whole. When you're trying to speculate, these are very short-term move driven. You don't want to speculate. You want to invest. That's long-term, and that's the disciplined approach where you're focusing on the goals. And the question I would ask, well, which of these two sounds, most appropriate for your financial picture or financial future? Hopefully it's the investing side. You can get in a lot of trouble trying to speculate and try to guess. A lot of people have gotten burned over the years and very dangerous. One of the phrases that I often say is don't make short-term decisions with long-term money. Short-term decisions are speculating, long-term money is investing. Something else a lot of people do is try to chase the returns. Here's like a guy, chasing something down the street. Short-term versus long-term performance. You want to focus on the long-term. Don't get caught up in short-term. Often it's easy. You open up your 401k statement and you see, oh, wow, emerging markets fund did the best this past quarter. Let's move everything or move more into emerging markets. Again, a bad idea. Often you're comparing apples to oranges, that, emerging markets is much more aggressive than the bond fund that you might be invested in. So it's very important there. I had a client think back in 2009 that said, hey, emerging markets was up 83% in 2009. I said, yeah, it had a fantastic year, but you know what it did in 2008? They're like, no. So, well, it lost 56%. And keep in mind, if you lose 56%, you don't gain 56% and get back to level par. You have to gain a lot more. And, if you gained 83% after losing 56, you're still not a level par. So you want to make sure it's there, and the balanced diet again, none of those French fry meals, eat your fruits, veggies, grains, all those type of things. Those are important. Timing the market. We've talked about that before, of not being fruitful. Here are some quotes from some pretty successful historical investors. Warren Buffett, many of you have probably heard of him. The only value of stock forecasters to make fortune tellers look good. It's just something that none of us have the crystal ball. It's impossible to really time the market. So here's a chart that shows of the return history of the S&P 500. In 2020, it was between 10 and 20% is what the US market was in those cycles. There are some negative years, and yes, they happen at times. Often some of the real negative years have a very solid up year. 2008 2009 was a very strong year, between 20 and 30% after the downturn in 2008. A lot of those things follow through. This chart is also in the booklet. Pretty much every third or fourth year on average is a negative year. that we have there. This one I'm going to skip ahead as well. That one is also in your book. This is always pretty amazing to me. Fun and amazing fact: if you invested $10,000 in a Vanguard 500 index fund, which again replicates the U.S. stock market, if you did that in 1980 and no money in or out since that point, as of November 30th, you would have had 917,000. So again, that's almost a 40-year stretch of time. If you put in 10, you have 917. That is the power of disciplined and long-term investing. You don't want to jump in and out. You don't want to miss all those type of things. So it's that patience and discipline that rewards investors. Again, timing the market, not the wise thing to do. You have to know when to get out. You have to know when to get back in. It's a bet. Odds are not in your favor. It just doesn't work. It's mostly luck and not skill, because nobody knows when that bottom is. Nobody's sitting there waving a flag and saying last March 23rd, hey, we're at the bottom. Nobody would have predicted that would be as well. I'm gonna jump over that one. That's in the book as well. Using actively managed funds is number 6 on the list here. And there's a difference, when you're investing in mutual funds, you can invest in what's called an index fund or passively managed fund, or an actively managed fund. An index fund follows that part of the market or the index. And at Vanguard 500 index, which the church has a lot of their investment portfolio in that fund, widely diversified, a good one, the cost of that fund is 0.03. That is the expense ratio. That's what Vanguard, the mutual fund company, gets for basically using their fund. 0.03 is extremely low. The average fund in that same space, an apples to apples comparison, is 0.91%. And those are basically the actively managed funds that are out there. So an actively managed fund has to outperform an index fund by not far from 1%. That is a pretty big ask for doing that. So active management is something that typically doesn't work so well because there's a lot of market timing within there. This is a chart that's in the book, and for the sake of time, again, I'm going to move on for that one. This is a quote from Warren Buffett saying most investors will find that the best way to own stocks is through an index fund that charges minimal fees. Again, the best way to do it, passive or index funds instead of the more expensive actively managed funds that time the market and some of the other things that are out there. Rebalancing a portfolio. So what does that mean? So if you start and you figure that your mix of portfolio is 60 stocks versus 40 bonds, and that's where you think you should be. Well, as stocks do better and stocks return higher than bonds, that will, over time, the stock market does well, you will have maybe 65 or 70% in stocks and only 30% bonds. It doesn't mean bonds are losing money. Stocks are just outpacing it. And it's like that's, it's that balancing act. So if you don't rebalance, that's going to increase your risk, because if you want to be 60 stocks, 40 bonds, if you don't do anything, at some point you might be 70 stocks, 30 bonds, 80, 20, and so forth. And again, that's your risk. So what we typically recommend, if a range of 5%. So if you're 60 stocks, 40 bonds, if that's where you should be, once your portfolio grows to about 65 stocks, 35% bonds, then you should rebalance, meaning sell from the stocks, put in a bond. So now you're back at the 60% that you have there. Costs. This is super important. In terms of the costs that we have there, some investments, there's sales charge, there's expense ratios for the funds. We've talked a little bit about that before, whether it's management fees, there's what they call 12B1 fees, which sometimes if you're working with a salesperson, that they get some of that. There's commissions, trading costs that sometimes a salesperson gets. Annuities often have additional expenses as well. Advisors, I haven't seen an advisor yet that works for free. Advisor fees can eat away there. And the thing about advisor fees, most of the time, if they're reasonable, they're well worth it. And you just want to make sure they're transparent and known. So working with an advisor, make sure you know exactly what those fees are and ask questions like, well, how do you get paid? Or if they're recommending something to you, well, what do you get out of this? Do you get a kickback? Some advisors get all of these compensation all through this method. Fee-only advisors, are advisors that really don't have the conflicts of interest to push certain products, and they just charge a percent of your portfolio. I'm not saying they're 100% clear of conflicts of interest, but there's less conflicts of interest for those folks. They're not getting commissions or some of the other things that are involved there from there. So fee-only advisors, typically some of that's not there. Costs do matter. Here's a chart: growth of $1 million over 30 years. If you get if 8% gross return and fees are 1%, you would end up with 7.6 million. If fees are 2% instead of 1%, that costs you almost another $2 million of growth and compounding, something we really haven't talked about yet. So some really important things. So bottom line is just know what you're paying for. It really does. Costs do matter. If you're working with an investment advisor, just make sure there's full transparency. You know exactly what you're going to get. For sake of time, we're basically out of time. I'm going to skip over the alternative one. We talked about a lot about this before. This chart is in the book too. Gold peaked in about 1980. It hasn't gained where it was before. There's no dividends or interest. That's what speculative alternative investments can do. If you buy at the wrong time, you're in a losing end, and it takes 20, 30 years to get even close to where you bought. So be careful. And then finally, sort of in closing, as I started out this section of it, that, coming full circle, most mistakes we talked about centered around emotional or behavioral mistakes. So, there's cycles that go through. People panic, the herd mentality, short-term focus, lack of expertise, all those type of things that are out there. So you want to make sure that you're doing that. There's some bad influences. If you watch Jim Cramer's entertaining. He's an entertainer. I wouldn't not listen to him and invest how he says, because he knows nothing about your personal and unique situation. Taking the long-term approach is not something that, Jim Cramer, again, is, and not to diss him, but, he's an entertainer. So don't listen to him and say, hey, this stock might be hot, and get into it. More than half the time, there's actually study out there that he's right with his predictions about 44% of the time. That's less than half the time. Half the time he is correct with it. So again, as I said before, don't make short-term decisions with long-term money. So in closing, focusing on what you can control. You can't control the stock market. You can't pick winning stocks consistently. You can't pick superior mutual funds that are always going to outperform. And again, you can't time the market. So what can you do? You can control expenses, diversification, and again, that investment discipline. And successful investors, really, it's that story of the tortoise and the hare, where slow and steady often, wins the race. So patience and discipline are very, very important from there. In your booklet, you're going to see this chart, which is an investment success checklist. I would encourage you to take a look at that one. That is in your booklet on page 32. Again, your PDF is page numbers, and unfortunately, I apologize. The written, the printed text does not have page numbers on there. So that is in there. The last thing, and I'll put a quote on the screen, you can read that through there, sort of makes me laugh a little bit. But in the booklet on page 32, there are some resources that are out there. I'm going to pull this down just quickly before I do that. Pastor Stephen said that the investment report said that our investments gained 15% in 2020. That was the rate of return for 2020. I think over the past almost 20 years that the church has been investing, it's somewhere in the 8-ish% range, give or take. 65 stocks, 35 bonds is that one. Somebody else asked, what is a reasonable management fee? I would say something under 1%. A lot of advisors charge 1%, 1.25%. Anything above 1% starts to be, I think, a little high. So something underneath there for all of those type of things. So all that's there. The last thing I'm going to leave you with is, again, on that last page in your printed materials, there's a couple of resources there. I'm going to pull down the slides here so you can see. I'm going to hold these up. There's 2 books that are referenced there. I think there's a copy of the first one in the library. There's one called The Investment Answer. Very short, very easy read, probably an hour and 15 minutes. It really simplifies investing, covers a lot of important things, a lot of stuff that we talked about tonight, frankly. And then another favorite is one called A Fly on the Wall Street book too. It's almost, it's good for all ages, but especially younger, people. It's very short and it's sort of told in a story format. Great way to teach younger people about that as well. So sort of in closing, as I said earlier, any questions you had, please do reach out. I'm here to help. Be a resource for that. We are recording the sessions. You can probably see up in upper left-hand corner, it says that. So if you can't make a future one, Sue will have that posted at some point. Next week, we're talking about sort of a secure financial foundation, getting away from investments, but moving into financial planning. Next week is appropriate for all ages. We'll talk about what, is a solid financial foundation. Again, next week, there is some pages in the that are workbook-like pages in the printed material. So if you didn't pick one up, would encourage you to do so. And like I said, if you need help getting a printed copy in your hands, let you know, and I'll try to make that happen. Last thing I would say is, if there's anybody else that, you think benefits from this, share the recording or give them the link to register. It's not too late. People can jump on board at any point in time. So with that being said, that's there. I think the question for the one book, younger people or children, I will take a look at this book. I think it's probably children. You can see some of the illustrations that's in there. So probably not, 20-something-year-old, but probably younger children is what that Fly on Wall Street's better with. So anyways, that's all there. And we appreciate your attention. I know we went over, so but again, appreciate you joining us. And any questions, please let me know. And without further ado, we'll call it a night there and we'll close on down. Thanks again for watching. Have a good night now.